Welcome back to the Money Wisdom Podcast, powered by Johnson Bernetti. We're so pleased to be with you. My name is Jake Dozer, certified financial planner and an advisor on the team here in Connecticut. And of course, across the table virtually from me is Nick Colantuono, a certified financial planner up at our Massachusetts offices. And we have a question today that's an interesting question. It's something that in some form or fashion does come across our desk quite often. And this is what this listener and viewer had to say. They said, I'd like to be debt-free heading into retirement. First of all, who wouldn't? And I now have the funds available to make that happen. Congratulations. Will that kill my credit score if I suddenly pay everything off? And I think that question is probably the tip of the iceberg. I think a lot of times when we're thinking about a large milestone like that, like debt reduction or debt payoff entirely, the question is not only, is this going to hurt my credit score, but really the question behind the question is, what do I need to know about this and how do I make this decision? There's so many directions we could take this, but Nick, what's the first thing that comes to mind when you're thinking about a huge milestone as far as a mortgage payoff is concerned?
Yeah, it's a big one. That's a big one. I mean, I think that's the milestone when it comes to debt that everyone's looking to hit, whether it's paying off student loans or things like that. But yeah, you pay off your house, everyone thinks, okay, smooth sailing. So I mean, the reality of it, Jake, there's good debt, there's bad debt. I mean, everyone wants to head into debt or head into retirement debt free, but there are certainly situations where that doesn't make sense. Now, to address the viewer's question, you had mentioned, you have the funds available to do it. Well, okay, fantastic. But keep in mind, you pay off that debt, all of a sudden those funds are no longer available. Maybe you need that money for other goals you have, or travel or vacation or gifting or whatever it might be. So keep in mind, nothing for nothing in this world. You want to pay off debt, you got to come up with money from somewhere else to do it. Yes, not having that debt eliminates interest payments, eliminates, that just burden. But like I said, when it comes to a house or when it comes to, other types of quote, good debt out there, I mean, maybe that burden isn't the worst thing to have. Maybe the cash in the bank working perhaps a little harder for you is more opportunistic. Who knows? So that's one thing that I would consider for the viewer, for the question, for the person who asked the question, just to think about liquidity, right? Paying off that debt now means you're probably in a position where you've got a lot less liquidity. How does that impact you going forward, right? So what else should we be thinking about?
Yeah, absolutely. Cash flow is king in retirement. You don't want to be house rich and cash poor. And a lot of times I think that we conflate the value and the mental and emotional success that we feel for being debt free. And we associate that with, okay, now I can enter retirement stress-free because it feels like an item that we can check off our list. When in reality, sometimes it doesn't make sense to speed up that payment process. I was actually just speaking with a client literally before a recording today. And, she said, for a long time, I thought about wanting to be debt-free in retirement. And then I realized the amount of, to your point, Nick, liquidity that I would lose in order to be debt-free. And while it would nice to not have those payments, wouldn't it be better to have a healthy cash flow? And maybe if I pass away with a mortgage, then my family can simply decide, do we want to pay this house off and keep it? Or do we sell the house and pay the mortgage off either way? And so, yes, it's wonderful to not have debt. I'm not necessarily a proponent of debt, but sometimes good debt, low interest debt, isn't as dangerous as it may seem. The other thing to consider is the fact that sometimes we think, oh, being debt-free is wonderful, and my mortgage, I'd love to not be paying that interest. Well, remember, this is a technical thought, is a mortgage is amortized. That's a fancy way of saying is that while your payments remain the same through the life of the loan, you're paying more interest up front, and then you're paying more principal on the backside. So for instance, listener, if you are at a 5% loan, but you're in the last year of your mortgage, you're really not paying 5% interest any longer. You paid a majority of that interest up front. So at this point, you aren't saving 5% anymore. You're only saving 50, 100, couple $100 of interest each month. I'm not saying it's nothing, but I'm saying, think of the opportunity cost. Would you rather save 1 or 2% of interest, where you may be able to make, I don't know, 4, 5, 6, 7% of interest in an investment. Where is your asset going to be deployed or leveraged in order to yield the best overall benefit to your plan? That's where that word plan comes back to anchor the way that you think. Making these decisions of debt reduction, cash flow, retirement timelines, all needs to be centered around the idea of how is this decision being made in concert with the rest of the decisions and the rest of the pieces of my finances. And I would be remiss not to mention one last thing. Well, you know what, Nick, I'll let you answer this. We were talking a little bit about before the camera, is paying off a mortgage going to kill my credit score? Is that, I think that sometimes we think that. Is that really true?
I will debunk that myth. Right. So again, it is not going to kill your credit score. Could it have an impact on your credit score? A couple points here or there, for better or for worse? Sure. But, if now you're in a position where you don't have debt, well, why would you then need a really good credit score to go out and get all this debt? Right. So
great point.
Yes, it could potentially impact your credit score to the downside, but we're talking, a couple points here or there. I think it really comes back to what you had mentioned earlier, Jake, the idea of opportunity cost. I mean, we're coming across so many clients, so many folks that we're seeing who just hit home runs, refinancing their house over the last 4 or 5 years at 2.5%, 3%. It's like, oh my God, if we could all go out and get that right now, that would be awesome. So think about that. I mean, if that debt that you have is at 2.5%, 3% interest, or that money that you have, working harder for you, well, maybe you had it in the market last year and you got 15, 16%. So where would you rather have that money? Paying off a 2.5% interest rate or able to make, really, really good, reasonable rates of return. So it's all about leveraging the dollars that you have. If paying off the debt provides you with the most leverage there, then so be it. Let's put a plan in place. Let's make sure we're tackling that in the right way. But let's also make sure that is the best approach for you.
Yeah, and that's so critical. And with anything in your plan, make sure that when you're making a large decision, you're looking at all the angles. There's so many levers to pull in this circumstance. How does this impact my credit? How does it impact my cash flow? Does it help me sleep at night better? Is my money better deployed elsewhere? And so many more things. That's really the moral of the story with all these conversations is how do I make sure that all these decisions are being made in concert relative to my overarching plan? Again, Jake and Nick with Johnson Burnetti's Money Wisdom Podcast. We'll see you next time.
Investment advisory services offered through JB Capital LLC. Insurance products offered through JN Financial LLC.